Valens Research, Uniform Financial Analytics.
For those who don't know, Toll Brothers is a home builder. It's a high-end home builder. They build luxury homes as opposed to somebody like a DR Horton who builds more entry-level homes and homes for those who are looking to downsize. But when we look at Toll Brothers, something jumps out immediately, especially when you think about the struggles that the home builders survived through for the purposes of the Great Recession. I almost said the Great Pandemic. The Great Recession, right? Most home builders had negative ROAs in 2007 to 2011. In fact, as reported metrics even show that Toll Brothers did. In reality, Toll Brothers did not have negative ROA ever. Toll Brothers' ROA was actually remarkably stable through that whole entire period. Their client base, which are buying, McMansions, et cetera, were less impacted by the Great Recession and more resilient. And so because of that, they had steady profitability, not rising ROAs. You can look, if you saw this ROA trend that the orange bars, the as reported metrics are showing you, you'd expect to be seeing TSR that went like this, that went through the roof. In reality, because returns never really came down and have been relatively flat, this company has had also flat TSR. But the other important thing with Toll Brothers is on an as reported basis, somebody like DR Horton, for instance, has a 10 times PE. So does Toll Brothers. So you would think that they're both reasonably similarly valued, and it's a question about fundamentals there. In reality, Toll Brothers trades at an 18 times multiple to DR Horton's 11 to 12 times multiple max. That just highlights how wrong the as reported metrics are in terms of helping you understand this company's valuation, and therefore how you should think about relative value for this versus its peers. Literally, you would make wrong decisions if you were going to do a relative value trade between Toll Brothers and DR Horton if you were looking at the as reported metrics. And also, right on the as reported metrics, you would see a 10 times PE, and you would say, oh, you know what, that must mean that expectations are for returns to collapse. But an 18 times PE, the market's pricing returns to be remarkably stable. This isn't a cheap, undervalued, high-quality home builder. It's a fully valued home builder, unlike some of its peers.
Valens Research, the world's leading source for uniform financial analytics.